to buy a larger property, we raised money. And in order to raise that money, whether it be, $1 million, or I think in our last deal, it was $10 million dollars that we raised, we have to answer and be accountable to those investors, and they have to be compelled enough to want to invest in it. So right. These are, even though they are real estate, these are businesses. And I know I was told that a lot when I was running these single families from one of my friends she was a pretty hard-nosed property manager. She'd be like, Stephanie, it's a business. It's a business.
It's really good.
And that's why I think putting your money into a syndication is, better, because you are the investor that the team has to answer to and wants to impress, by and large, for you to invest again.
I think that's really well said, Stephanie. That makes a lot of sense. When you're managing a rental property down the street, potentially in your communities, and it's a family, there's probably more grace, maybe a little more soft-heartedness. But when your tenant is a rock climbing gym or a Big Five, it's, hey, this is the agreement. This is the contract. We're executing this. Welcome, everybody, to another episode of the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. Today, I am here with Stephanie Walter, wealth strategist, capital raiser, author of a new book titled Shattering Money Myths, How the Wealthy Invest. And she's also the CEO of Erbe Wealth. So I'm stoked to be with her and to learn from her today. Stephanie discovered something very interesting that we're going to spend some time digging into. And I believe it's also the theme of her new book. And that is that the wealthy do something different. They do something different with their money, their finances, their financial strategies. They use leverage to control assets over long periods of time that create wealth. While if we contrast that against what most, let's just say non-wealthy do, they spend decades trying to pay off debts, and they forego or postpone the asset accumulation phase, and they don't really understand how to appropriately use leverage to catapult themselves or to vault themselves forward towards wealth. So the good news is Stephanie's here to explain that to us today. I'm super excited to have you, Stephanie. Welcome to the show.
Thanks so much for having me.
My pleasure. My pleasure. And I am fascinated by your history a bit here. So let's start there, if you don't mind. You had a successful career as an insurance company owner. And after, I think it was 16 years, you decided to move on from that. You sold that business, and now you have become a wealth strategist, an author, a CEO. So just walk us through a little bit about, how that happened. I'd love to just know a little bit about where your entrepreneurial spirit came from, and where did these lessons, where did this awareness that, the wealthy are treating money and their strategy towards finances one way, and the wealthy or the non-wealthy are treating them very differently. So bring us full circle there, if you would, Stephanie.
Yeah, well, I did start an insurance agency in 2006, I guess. But before that, I had tried, corporate world, and that, wasn't really for me. I remember getting a 2% raise and going home and talking to my dad, like your mom, sounds like a serial entrepreneur. He was actually, fairly successful over his life. And I was telling Dad, I got a 2% raise, and I don't know, I'm just sort of bummed out about it. And he was like, well, you could do two things. You can either stay and you know what you're going to get, or you can leave, and what you achieve basically is up to you when you're running your own business. So I put in my 2 weeks notices right after that, jumped into the insurance agency. But I always, again, my dad's, advice always, he passed away actually shortly thereafter, actually in 2006. But I remembered a lot of things he said, one of which was, don't put your eggs all in one basket. So I had this insurance agency, but with every amount of money that like a bonus or a fairly large commission check, I would buy a piece of real estate, just kind of a small, I didn't know what I was doing, to be honest with you. I, bought based on location, in areas where I thought, like in Denver, that there'd be growth. And, I happened to be right on that, but yeah, my love was really, running the business. And in 2016, I was invited to a boot camp by one of my friends that knew I loved investing in real estate. And it was about buying apartment complexes. And it was the concept, or the new concept that was sold at that meeting was syndication, which I'd never heard in my life. And I absolutely love the concept, which is a group of people buy something that no one could do on their own. And I was sold. So from that moment on, I, dumped myself into the education, kept my other business running, and closed on my first syndication in 2018. Then after that, realized I didn't like doing it by myself and needed a partner. So I teamed up with a partner, and we closed over, we have over 300 million in assets under management right now.
Awesome job.
And, but during COVID,
how many years, Stephanie?
But I'm sorry.
In how many years?
I started working with him in 2019.
Fantastic.
Yeah.
Way to go.
Yeah. So we, but actually 2022 was our last acquisition. And that's when I had some time to myself, a breathing a moment after all these years of hustling. And that's when I really started thinking a lot about my investors, who I love them dearly. Most of them are quite accomplished and very smart people. But that's when I started kind of reflecting on, how they look at money, how I looked at money in myself, actually, because shortly after working with some of these wealthy people, I kind of put it together how they were thinking about their money. And I, in 2020, I guess, over the course of 2020, 21, 22, I started selling all my single family rentals and investing them in our syndications. And that's truly what gave me the passive income to be able to retire. Though I that's just not in my nature to retire. So I wrote this book because I felt like it would help people think about money differently. I feel like anyone can achieve this lifestyle, and I truly get to do what I love, which is help people, strategize and just improve their financial situations.
All right. Well, I'm almost on my second page of notes, so thank you for that. I want to net out a few of the things that you just mentioned, because they are common themes on the podcast. And I just want to highlight them, because sometimes we can lose the importance of these little nuggets. And I want to just put them together. I was doing a podcast with a gentleman just yesterday. His name was Igor Kajpust. He's 27-year-old, Stephanie, and he's been buying and flipping and wholesaling real estate since he was 17.
Wow.
And, what came up for me as I was interviewing him was like, where did this guy get the courage at 17 and the constitution to start buying and selling and real estate and believing in himself and just figuring it out? And as I hear you today, I'm reminded of that same courage. You got a 2% raise. You sought wise counsel from your father. He gave you the choices, either like it or do something different, one or the other. And there's again, you had the courage. You had the courage to say, no, I don't like that path. I'm going to start a new path. And as you started down that new path, all these new awarenesses, all this new wisdom you started to learn, and the doors kind of opened, the dominoes started to fall out in front of you. So So often it starts with that courage to believe in ourselves and to take a risk, because you took a significant risk at that moment. The other thing you said was, the other thing I heard you say, feel free to correct me, is that as you started to become successful in your insurance business, you realized that you needed to exchange, these are my words, not yours, but I think this is what you're saying. You needed to exchange that fiat currency that you were getting paid, dollar bills, that the treasury is able to dilute and print, forever without any real constraints, it seems like. And you decided, all right, I'm going to take that fiat currency, those dollars, I'm going to convert them as fast as possibly into real assets, single family real estate, other real estate assets, with the goal to create cash flow. Eventually, those assets swell over, it seems like a 16-year period. You liquidated that portfolio. You put all of that money into a syndication, which we're going to clarify for people who don't know what that is next. And that enabled you to, quote unquote, retire. I would say that led you to a point where you escaped the rat race. You had enough money coming in every month that you got to do whatever you wanted to do with the rest of your life. People may call that retirement, but I think you just enabled you to operate in your genius zone.
Mm-hmm.
What would you add to that? Did I get it right?
You got it right. You got it right. I think I did have some, like where you say it's courage for me, because I remember when I started buying the single family homes, one of my friends was like, I was buying my second or third one. She's like, doesn't that just make you scared? That what if the person doesn't pay the rent or whatever? And I was so like, that was a new concept to me, because I didn't think what I was doing was particularly brave or risky or having a lot of courage, because I'd seen it. I'd seen my dad model it for me. So I believed it. And if it didn't work out, that's sort of always been my philosophy. If it doesn't work out, if I fail at this, then I need to try it from a different way, and so I mean, what's the worst that could happen is sort of my feeling. I have to evict someone and then put a new renter in, but yeah, no, I think it's definitely mindset is a huge part of it.
Well, great job for pushing through, whether that was, I know for me, there was definitely some fear involved. I remember a specific moment. I can actually tell you where I was and the time of day it was. I was looking at our spreadsheet with our properties, and I was adding up. We just acquired a couple of properties within a short period of time, and I was adding up the columns, the monthly outgoing expenses, the monthly rents, and I totaled up the amount of the monthly mortgages, and it occurred to me that was more than what my monthly income was from my business. And I had one of those moments where I went, oh boy, if this doesn't go right, if these properties are vacant, I am bankrupt. Like I have more liabilities now than I have income from my main job. This is really scary. And what was interesting for me, I don't know if it's true for you, the more properties I owned, that fear went away. And I think it went away because A, I had more experience, but B, I felt diversified. I had 30 properties instead of 6. And I realized that, well, if I have 3 vacancies, who cares? Because the cash flow from the other 27 absorbs the 3. But when I only had 3 or 4 properties, if all of them were vacant, I was really kind of fearful. Did you ever have a moment like that where it was just kind of like the gravity of the situation hits you?
Gosh, I mean, I just remember going, I think maybe I would have, I was just really lucky with the people that were in renting from me. I felt I didn't do it exactly right. Like I didn't have a property manager do all that. Mm-hmm. So it made me feel much more in control of everything. Yep. And I had my hands on the properties. They were here in real close by, so I could check on them. So I, knock on wood, I was real lucky with that. So no, I don't think, I mean, I always just felt like that money would come. I guess that's always been my philosophy is if I'm in a bad situation, money's going to come, I've just always had that the view.
That's beautiful. I love it. You're more fearless than me. We figured that out in the first 10 minutes. That's great. Okay. Let's go to syndication. And then I want to go to your book, Stephanie, because I really want to dig into that and more about the difference or the dichotomy between wealthy and non-wealthy and how they think about money. But let's clear up the word syndication, because you said you sold your single family properties, residential properties, maybe you said, and you moved into syndication. So can you explain that for us?
Well, that I didn't do it immediately, but I did a few syndications.
And what is a syndication? Let's start there just so people clear that piece up.
So a syndication is where we buy a commercial piece of property. I'm saying we, as in my partner and myself, we vet or we look over many deals and find like a jewel, and then we figure out what we're going to do with this jewel. Our first property actually was a retail center that we bought off market in Tallahassee, Florida, which is where my partner's from. So we got a smoking deal on it. There was a fairly large vacancy in there that we had figured out that we could bring a rock climbing business in there.
Love
that signed on with us before we had even bought the property. And so we ended up being, so then after we get it under contract and go through all the due diligence and get the loan, then it was my job actually as part of the team to go out and raise money. So you go out and you find investors that want to put 100,000 or more into this property. And these investors are truly passive investors. Not passive, like I own a single family home. It's you have literally no responsibility. Myself and my partner report to our investors on a quarterly basis, and we send them monthly distributions or cash flow essentially that we promise. What for us that was like at 8%. And then we're selling that particular property this year. And we will have returned 40% annualized returns to our investors.
Wow. That's fantastic.
Every year. So what I did, so then as I started working with the investors and looking at these returns that we were promising, I was like, that's when I first had my first realization that, hey, usually a pretty wealthy person doesn't own property. They do sometimes, but largely they're involved in syndications, and they're in syndications because they have other things, better things to do with their money. And once they do the due diligence and they get the cash flow coming in, it's an excellent return. It's a better return. My money was sitting, my appreciation was just sitting in my homes. So to be able to sell them and put the money here, my money was working a lot harder for me in these different investments.
I've noticed that as well. And I traveled a similar path in that at one time, my mom and I owned, I don't know, I think it was like 67 residential units. And we started to move up. First, it was into a small apartment buildings. Then we bought the office building that our business is in, which we office next to each other, have for the last 20 years, which is kind of cool. And then
I office next to my sister. She's in the next room. So.
I love it. If you got good family, there's no better business than the family business. It's so much fun. I dig it. And then we moved into medical office space and eventually into retail space. And I've noticed the same thing that you alluded to, that the returns on the retail and the medical office are greater than the single family. But can you explain why you think that is? Like, why is the cash flow from this particular retail investment that you just talked about so much better than the cash flow on single family homes? How would you describe why the syndication was a better cash flow environment for you?
That's a good question. I think, for myself, I can only go back to think that what my goals was purchasing real estate. just buying the real estate, and I'll be able to pay the mortgage and all the expenses and have maybe $100 or $200 for me personally. And I was actually I'm in a investors group here in Colorado, and we met yesterday. We were talking about that, and we compared it to a person running a business, even me in my insurance business, and you're concerned with running your business, you really you have no investors that you have to answer to. And you're just, you don't really have, most people running businesses like that have no exit strategy, have no value that they're planning to bring to the investment or the business. So for us, I believe, we have to, to buy a larger property, we raise money. And in order to raise that money, whether it be, $1 million, or I think in our last deal, it was $10 million that we raised, we have to answer and be accountable to those investors, and they have to be compelled enough to want to invest in it. So these are, even though they are real estate, these are businesses. And I know I was told that a lot when I was running these single families from one of my friends she was a pretty hard-nosed property manager. She'd be like, Stephanie, it's a business. It's a business.
It's really good.
And that's why I think putting your money into a syndication is, better, because you are the investor that the team has to answer to and wants to impress, by and large, for you to invest again.
Yep. I think that's really well said, Stephanie. That makes a lot of sense. When you're managing a rental property down the street, potentially in your communities, and it's a family, there's probably more grace, maybe a little more soft-heartedness. But when your tenant is a rock climbing gym or a Big Five, it's, hey, this is the agreement, this is the contract, we're executing this as a business partners, not as people that go to the same congregation, right? It's run differently. So that's a great point. And you made the mention that you were able to buy that retail property with a big vacancy in it, which probably gave you a little pricing negotiation power. And then you were able to solve that problem by putting in a rock climbing, which of course increased the valuation of the building from get go. So there's probably more opportunities to make an increase to the valuation of the property by raising rents. Mm-hmm. Great call. Wonderful. Okay.
And we're basically also, I'm tagging on to my partner, who is, he has been a commercial broker in Florida for 40 years. So he knows how to find the deals. So that's why when people are like, why shouldn't I just do this myself? You can, or you can team yourself with a partnership that really knows what they're doing. And that's why you get higher returns.
Yeah. I just, because I think sometimes real estate terms can confuse people. So I literally just typed in syndicate, and it's a group of individuals or organizations combined to promote some common interest. And I think that's a great definition. And by extension of that, you bring together a group of people who are probably more sophisticated than you, have more knowledge than you. And so the returns are then outsized because you're leveraging the collective intelligence who's running that syndicate. So that makes a tremendous amount of sense. And I think we did a good job clearing that up. I want to come back to syndication, and I'm gonna pitch you a couple of tough questions around the risks around syndication. But before we do that, I'll let you think about that for a few minutes. I want to go to your book, because I watch, and I'm like this voyeur in a lot of chat rooms, a lot of Facebook groups, and I see clearly the difference in the thinking between the wealthy thinking, and I'll just call it the non-wealthy thinking. And I would like to hear your description of the difference of those two types of thinking, and specifically some of the things, maybe just dive into some of the things that you point out in your book. I think it'd be really, really valuable for us.
Well, I'll start out with mindset of a wealthy person, even if you're not wealthy, but someone who becomes wealthy, you have a mindset of abundance. I think I mentioned that a little bit, is that
Yes.
I just believe that money would come. Abundance mindset is there's enough money for everyone. And we put that against scarcity, which is a lot of non-wealthy people have a mindset of scarcity. So if I am doing better, then that means someone else is doing worse. There's not enough money. I use a good example of your 401k, and you get to the point of retiring. You've got this little nest egg, but you have to draw out all the money that has to last you the rest of your life.
Yep.
You start getting scared as soon as you start drawing down this money, and all your focus is this money is depleting. Oh my God. That's scarcity. Abundance is, cash flow. Money's always going to come. And I guess another point I make in my book is that they use money completely differently. A non-wealthy person uses their money, basically they view it as accumulation mindset. So basically I'm going to contribute to my 401k. I have no idea what it's invested in, what the fees are. I have no idea, but I'm just going to keep pushing my money that way. It could have even been me early in my career when I was buying houses, and my whole goal for buying houses is I'm buying these houses, I'm going to run them for 30 years and then I'll retire. So, just put the money and get it into a place and let it grow. Like, even grandma has it under her mattress or whatever.
Right.
But the wealthy, the way that they use money is called utilization mindset. They're using their money at all times. I try to make the analogy that people that have money or, have this mindset, think of their money as their employee. They literally look at their money as, what are you going to do for me today? Not it's sitting under, it's sitting somewhere where it may grow or it may go down. But yeah, what is my money doing for me today? That's when I started viewing my rentals that way. I've got a lot of money just sitting, not giving me cash flow, and not really looking at other places to put that where the money could continue growing. And many times the wealthy are smart enough that they have their money in several different places at the same money invested in several different places at the same time, which, a more advanced term is velocity of money. So they understand the faster they can get their money moving for them, the more money they'll have.
Let's go deeper into velocity of money if we could, and this idea around utilization in several different areas. I've heard you say that the wealthy are utilizing their wealth by using it in several different areas at the same time. Can you just go a little deeper on what you mean by that?
Yeah, well, I'll give you two examples. I have a friend who does these, it's called an all-in-one mortgage, and it's a different mortgage than a 30-year fixed. Okay, so you go to a bank, if you've got some equity into your house, it's essentially just a way of setting up your mortgage in which it gets paid down much faster than than a 30-year traditional mortgage. So by doing that, you're able to, your equity is liquid, not like it is when you pay your mortgage, not like with your mortgage, that kills me. Even like you've got your mortgage paid and say something big comes up. When I was an insurance agent, I'd hear, oh, my sewer line. But, they've got to go through the whole home equity line of credit they just can't be like, hey, I paid, several hundreds of $1,000s. Can I get $10,000 back to do what I want? No. So there is not that liquidity. So that's one way of doing it. So what some people do is take that money out the liquidity and realize what they're paying on that and make a better investment that they perceive. And it's, they make money based on the arbitrage, which is really the difference of the money. Another way, which I have become quite, familiar with, just because this is something I've seen a lot of my wealthy investors do. And it doesn't have to always be wealthy. You can certainly implement something like this if you're not.
Sure, you can act wealthy before you're wealthy, right?
Yeah. But the thing I'm thinking of, which I think is quite brilliant, is premium finance life insurance. And that specifically is people that get life insurance and they overfund it essentially with a bank. So a bank is actually funding 80% of their premium. The insured or the client funds 20% of it. So, and then that it just grows. These are designed by people like myself that are wealth strategists that know how to get this money growing. And then in 10 or 15 years, this becomes tax-free income to them. If they don't need the tax-free income, it becomes something to which they could handle their estate, if there are any estate problems. But for the average Joe, you should still take out one of these policies, because once the money's in, if you're overfunding your 401k, you should consider this as your alternative, because once the money goes into this product, it's tax-free, it grows tax-free, and it can be taken out tax-free. And it can be structured, just like I said, as a supplemental retirement account, which a lot of people don't know. And then they hear life insurance, and then they freak out. But actually, life insurance has been used this way by the affluent for forever, really, since the beginning of time.
And you said the word tax-free, just so that I'm clear, the contribution to the life insurance account is tax-free, or just the growth and the disbursement is tax-free?
So when they contribute, it's after tax money.
Okay, got it.
Okay, yep.
Growth,
it's kind of like
and
a
then
401k. Yep. But see, that's something I bring up in my book, is the whole design of the 401k is pretty messed up, because when it first came out, tax rates were historically high. I think that it came out in the Reagan era or something around there. So tax rates were at 70%. Right now they're like at 36, 38% right now. So we're sitting at historically low rates. So back then it made sense to put your money into a 401k, get that tax benefit. When we were going, now you'll be taking it out in historically low interest rates, or tax rates. I apologize.
Yeah, no, that makes sense.
But now we're looking at contributing money in a historically tax low
Right, that makes sense.
environment. And darn well, if you listen to anything, that they're going to be making changes in 2025. Everyone says they're going to be getting rid of where the tax rates were, and they're going to go up. So in that situation, it's not really beneficial to, I never say, if you're contributing and your employer is matching, that's great. Keep that up. But anything over that should be put into a tax-free account. And that's something that wealthy people are very attuned to, is they are tax planners. They are tax planners. And I would say the non-wealthy are not. And that's probably a combination of CPAs not being most of them not future planning for taxes, and the person themselves just thinking that they can't do anything about future taxes.
Yep.
Or not knowing, like some people really don't understand, when money grows tax-free and is distributed tax-free, it's a lot. It makes a big difference.
Yes. And I want to zoom out a little bit and go back to this theme that you offered, which was arbitrage. and tie back to this initial theme of how the wealthy have a higher velocity of money and how they're utilizing or taking their wealth from one investment vehicle, using leverage to put themselves in another investment vehicle. Now they control two assets, and both of those assets are creating cash flow and appreciation. Now, arbitrage, just very, very simply, is borrowing at a low rate and lending or investing at a high rate. So, super simple example. When our home equity line rates were 2.5, it made really good sense to pull money out of those home equity lines and go invest in a rental property, a bond, private money loan, a syndicate deal, anything that could create cash flow in excess of 2.5%. Let's say I could borrow at 2.5 and I could get 7% in my investment. I take my 7% minus my 2.5, and the difference between those numbers is your arbitrage. That's the difference between what you can borrow at and what you can earn in return on another investment. Let me give you a couple examples of that. I was reading an article recently that Carl Icahn had created a company and had a vast amount of wealth. He'd taken the company public. The valuation of the publicly traded company went wild. He still owned I believe it was the majority share, but if not, he was the largest owner of that stock. So did he just let that stock sit there and have the growth from that one stock? No, he didn't do that. He took out a margin loan against the value of that stock, and then he used that margin loan to invest in a whole different real estate investment or a whole different company. So that's exactly what Stephanie's describing. He increased his velocity of money by creating one asset over here, borrowing against that asset value, investing it over there, and the difference between his borrow costs and his return on that other investment is the arbitrage rate of return. And that's an example of speeding up the velocity of money. I'll give you one more, and then I'd love you to comment on this. Warren Buffett, Berkshire Hathaway, he owns insurance companies. Those insurance companies get premiums called float from me, you, all of us that pay our insurance policies. Then Warren takes that money, which is free money, right? I'm paying him an insurance policy. I'm paying him to hold that money. He takes that money in the insurance company. He invests it across all these other investments that then pay rates of return. And then if he ever has to pay out a premium, he's not just paying out the premium because to offset the fire from the float that he's received, but now he's taken that money and it's multiplying, and he's paying back a lot less than what he's earning. Again, that's arbitrage. Find an asset, borrow against it, lend it out at a higher rate of return, and the difference is arbitrage. What would you add to that? Any other examples or anything else you'd add to deepen the explanation?
A bank takes your money.
Fantastic.
He sits and takes your money, and you can get what? I don't know what it is now with the higher interest rates, maybe 2 or 3%.
Some are offering 4 or 5. It's crazy.
Okay. And then they take it and then they loan it out themselves and they get, 10, 20%.
Yep.
So that's how your beautiful banks, they get these big, beautiful buildings. I mean, that's how the money doesn't just sit in a bank. A lot of people think that, but that's not the case. Very successful businesses, like you said, insurance companies have arbitrage down to, and it doesn't actually have to be that high for insurance companies. It's usually just like 1 or 2% for them.
So I want to tie a bow on this, and then I want to go back to Syndicate. And this is my ADHD kicking in, Stephanie, in case you're wondering. I'm all over the place. What Stephanie is describing, what we're talking about here, is the difference between the way wealthy people act and non-wealthy people act. Non-wealthy, in contrast to what we just described, will control a house. They want to put it on a 15-year mortgage. and they're going to want to pay that debt off as soon as possible so that they can have enough money left in their 401k account that hopefully they die before they spend all their 401k. That's that scarcity mindset that is emblematic of non-wealthy. Wealthy say, cool, I have an asset. I've got positive cash flow from that asset. How can I borrow against that asset to increase the velocity of money to use that wealth in another area to create more wealth and more cash flow? So if you like this and you're interested and maybe you kind of understand it and you're like, oh, I can kind of see how that works, buy Stephanie's book. She's going to give you, I believe you have 10 different specific ways you go into that contrast the dichotomy between the way the wealthy think and act and the non-wealthy. Is that right?
Yes, for sure.
Yeah, right on. Cool. All right. We're going to give you a link to the book in the show description. I'm going to ask Stephanie as we close out in about 5 minutes to give you links of where you can follow her, where you can learn more about her syndication, where you can get her book. But before we do that, I want to, what I like to do normally with guests is pitch them softballs, but I'm giving you warning, I'm pitching you a fastball. Okay. Are you ready?
Yes.
It's low and inside, so be ready. No, it's not really that hard. I was just reading an article yesterday. It was either an Inman or Housing Wire, which are both real estate and mortgage publications. And basically it was blasting syndicators. There was a gentleman, and I can't recall his name, out of the Texas area. He'd accumulated, I think it was 3,000 residential units using leverage. A lot of his stuff was on adjustable rate loans, very little money on his own, made big commissions on the way in, and basically walked away from these non-recourse loans. And all of the people that invested in his different syndication funds lost the money. They were then essentially tying that into what Grant Cardone has done over the last couple of years, which is he's been a very boisterous about his success. He's created syndicate funds, invest alongside me. He's made claims that investing alongside him will make people 40 times wealthier than not alongside him. And if I got that wrong, it's possible that it was another syndicator that is part of the traveling show that Grant Cardone has. Maybe it was him, but in other words, there was a lot of really aggressive statements about the wealth they'd created. And hey, if you want to be wealthy like me and have a private jet, just give me all your money. And the article was really saying, hey, the risk here is really high in this environment. Be aware, there's going to be more fallout here. So what's the difference, Stephanie, with the way you and your teams run your syndications and what I might have just described as kind of like the more risky type of syndications? Could you give us some clarity there? Why invest with you when there's all this risk in the market?
Well, right now right now we're not looking to put together any more syndications. Right now we're waiting out and we're seeing what the market is doing. And I have people that call me like, I want to invest. I need to invest right now. Can you look at like another person's syndication? I'm happy to do that. I'm happy to educate my own investors to ask the right questions. But yes, I just like any other industry out there, there's good and there's bad. And that is, I don't think that fear should keep people from acting, because you can definitely vet these, especially if you have a mentor or you want to reach out to me. I love looking at deals, and you can, see what they're trying to do. And once you vet your first few deals, I'm not saying that you can't ever lose your money. It would be very hard to lose your money unless someone, like you mentioned above, is walking away from the deal altogether. But that is, I would say, pretty, I mean, I would hope it would be pretty rare, because that man is never going to be able to put another syndication together again,
We hope
because
so.
those investors with him would, never follow him to the next deal. What you want to find are people that know the market, have done, I'm just going to say what I told the man, one of my investors the other day. It looked like he was looking at one where these people were based in Houston, had done 11 deals in Houston, had a pretty conservative outlook. When people are telling you, I guess, you're going to triple your money or something in a short time period, 3 years, I would say when looking at deals now, you really have to look for the long term, probably 7 years in which your money would be held, paying, distributions between probably 6 and 8%, that cash flow. And then the returns hopefully would be in the high teens, low 20s. And those are realistic expectations. I think where people, all of us get thrown aside is when we get greedy and we say, oh my gosh. And I myself fall into that, because sometimes I'll look at it and be like, wow. But then you start like really doing your due diligence and being like, there's something wrong here, and you got to listen to your gut. But I think these deals are easier to vet than if you ask someone what's in their current 401k. They won't be able to tell you all the companies they're invested in, or who's running the companies,
or how much money they're making, what the scrapes are, what the fees are. Yep.
And so just I want people to take more accountability on their finances. And that's probably the first step in having a different life.
Super well said. And I completely agree with literally everything you said. I want to clarify something I said. I didn't mean to throw Grant Cardone into the bucket of people who had lost money. The article I was reading was showcasing verbose claims about profits, and someone had gone down and then mentioning that Grant might be in a little bit of trouble by the government. That's kind of saying like these statements are a little crazy. So I hope that none of those people lose money. I don't believe that he has lost money yet. But to your point, Stephanie, you said a couple of things that I think were spot on. Trust your gut. If it seems too good to be true and the greed, monkey is on your back, be aware of that. I am 100% aligned with you. Cash on cash distributions to investors in the 6 to 8% range is exactly what I'm seeing. If you can find a good deal, and if we can get these dang mortgage rates to go down a little bit, and what I would call the internal rate of return, which includes your cash flow. Those are the distributions, your quarterly shareholder distributions, partner distributions, your amortization of the mortgage, which is the reduction in the principal balance, and your appreciation. If you total those things up, you have an internal rate of return over 7 to 10 years. Somewhere in the mid to high teens is realistic. If there's more cash flow promised than that, if there's more internal rate of return over the lifetime of the investment returns than that, I can tell you, and Stephanie just told you, that's extremely difficult to engineer. It's not impossible, but claims above that are likely to have higher risk propensity associated with them.
Correct. Yeah, I'd agree.
Kick ass. Last question. This has been really fun for me, by the way. You're full of knowledge, so thank you. I want to ask you, what myth about finances have you learned and you wish everybody knew? And how would you set people straight around that potential myth?
Wow, that's a big question. I mean, I think, yeah, boy, I think it would come down to two things, which would be know more about what you're doing with your money. Because I think this 401k has gotten people just completely disconnected from what their money's doing. And they've just given up responsibility, which I think is really sad. Because I think a lot of people are making a lot of money, financial companies, 401k administrators, they make a lot of money for you not being aware of what's happening. And that's why this happens. I wish there'd be education in schools that would teach all these principles we talked about today, but specifically also is to really be aware of your tax treatment, diversification. Everybody talks about diversify your tax treatment diversification, which just means have some money that you get, and we all have taxable income. Then you have some that's tax deferred. If you have real estate, you have tax, there's benefits in real estate for sure, but have some in that tax-free bucket, because don't not think about that, because that's probably really the way that you can have money in the future is going to have a lot to do with the planning you did now.
I love that. Diversification across how your retirement income is going to be treated from a tax perspective. That's interesting. I've not heard that perspective before, and I really think that's a valuable. And people might be thinking, what the hell does that mean? It means you need to buy Stephanie's book. So with that being said, Stephanie, where can people find your book? Where can they find out more about you, your syndication? I don't know if you're actively doing any kind of coaching, but how do people connect with you?
You can go to my website, which is www.erbewealth.com. And that's really where you can sign up. My book is free to download. So I just have that offered right now. And then, you can set up a call to talk to me about any and all things financial. And I'm happy to, this is what I love to do. So, yeah. And the name of my company actually is the German word for legacy of, and so it means legacy of wealth. And that was a nod to my dad, who was a second generation German immigrant. So, yeah.
Is that what Erbe means?
Yeah. Erbe is a legacy. Yeah.
So good. And
that's what I want.
It's beautiful. And I can tell you're in your genius zone with it. I've mentioned before on this podcast that my definition of inheritance, it goes way beyond dollars. It's not the money. It's the lessons that come in creating the wealth. That's the real inheritance. And I can tell your dad left you a big inheritance in that way.
Yes, for sure. For sure.
Right on. Well, I hope to have you back for a future episode. This was fantastic. Thank you for being with us.
Oh, thank you so much for having me.